Lockdown might not have been all bad. It looks like it was good for some people's pockets, with over 15 billion euros saved around Ireland as a result.
Wow.
Did you all save your pennies now? In fairness, we were kind of forced into it because everything was shut.
I spent my savings on Amazon. I apologise. That's what I do with mine.
Maybe you should be putting that money, or whatever little you have, into a pension. It is never too late. On the line to chat to us about it, Rafe Benson is founder of Pensions Awareness Week and Moneycube.ie. Morning, Rafe.
Morning, guys. How you doing?
We're good. Do you have your work cut out for you trying to make pensions interesting?
Well, I guess, this year is probably a year where suddenly changing the subject to talk about pensions cheers everybody up and diverts them from the news,
For once, there's something worse than pensions.
Yeah, is that going to be your kind of tagline for Pensions Awareness Week? Is pensions not as bad as a pandemic?
Well, hey, you're the guys who introduced the word actuary into this conversation.
We did.
Yeah, you're right.
We did. Guilty as charged.
So 15 billion, you reckon, was saved? I mean, obviously, I presume there's a lot of people listening going, well, I don't have that, or what my percentage of that is pretty small. How much would that average out among the population of Ireland, like?
We're looking at about £4,000.
Good afternoon, everybody, and welcome to the very first live webinar of Pensions Awareness Week. So I'm here today with two experts. We have Rafe Benson, founder of Moneycube, and Stephen Rice, who is the lead of pensions in Aviva, and we're going to talk through some of the basics about getting started, why pensions are such a no-go topic for so many of us, and how to get really rich before we all retire.
I guess the big message we have today is that the hardest thing with the pension is making a start on it. So I guess if you're watching this, you've already taken that first step, and don't make the best the enemy of the good here. Your pension doesn't have to be perfect, it just needs to be working for you over time.
That you don't need to start by making really big contributions. Most pension schemes allow you to start with smaller contributions and to build those contributions as you move through your working life.
This pension stuff is so confusing. Can you explain a pension to me like I was a 10-year-old, please?
I'm like too old to start a pension. I'm thinking to start a pension, but am I too young?
I just want to talk about how taking charge of your money is, really important. And we have a video here from Matt, who has attended one of the Moneycube's events before, and he is going to tell us why he found taking charge really helpful.
It was complexity. It was the enemy is the best of the good. Haven't thought about it, should do it, haven't done it, worried about it, and therefore just not done it. Just pushed it under the carpet and avoided it. For me, I'm right at the start of my investment journey. I haven't invested anything in my life other than a savings account. So coming to an event like this with Finimize, Moneycube, I know I'd feel relieved. It'd be like a weight off my shoulder to have done it. So I need to find easy ways to do it, easy ways for me to put the money that I'm earning into somewhere safe that's going to get me a return. And that's what I need to do for me.
So that was helpful, Matt. We should all be a bit more like standard of living. So what exactly does it look like going forward for the average person?
Yeah, so look, I think, Liz, obviously it's a real positive, that people are living longer, and indeed not only just living longer, but are they staying healthier and more active as they live longer. And I think, look, what this slide really highlights is the fact that, at an emphasised level, we've seen a significant increase in age profiles, or the number of people who are reaching 100, even since 2005. So this isn't going back 40, 50, 60 years. That even since 2005, in the last kind of 15 years, there's been a threefold increase in the number of people reaching age 100. And what that means is effectively they're going to have to pay themselves for longer. If we take it back to a more practical level and pragmatic level, the average life expectancies now are somewhere around age 82. So, give or take, it's slightly lower for men and slightly higher for women. But that's the kind of age profile. Is that in Ireland or is that in Europe? Yeah, they're the Irish stats as they stand at the moment. And I think it's important to note that for younger people who are starting to save now, those age profiles are expected to increase into the kind of mid 80s if you look at any of these that are out there. So what that really means is that even if you're retiring at 65, 66, 67, you can now assume that you're going to have to pay yourself an income in retirement for somewhere between 15 and 20 years. That is really the critical thing. And I suppose the important factor of that is, the type of retirement that you can enjoy will depend on how much you actually put away now to support yourself in those later years when you do retire.
Like, what pensions are out there, and like, how am I going to start? Like, I don't have a pension. I need to start, clearly. And I'm a bit scared, so hold my hand here.
Yeah, I guess Liz, the way to think about it as a starting point is like a pension is a piggy bank that you can't smash until you're 60 or thereabouts. So you're putting money in, and it is your money. That's something that is kind of a lot of the pensions industry has maybe forgotten over time, but it's your money. It's got your name on the tin, and it is invested in assets that have scope to grow over the long term, and is there for you when you retire. That's kind of the foundation of it, right? It is a savings account which you can't smash for a few years. Now, pensions can be great, but you do need to do them right. Okay, so it's not without risk, but then doing nothing is not without risk either, right? So it's all about controlling that. So the pensions industry has moved on in Ireland in the last 8-10 years, and what represented a good deal then isn't necessarily a good deal now. So
now, Stephen, tell me about this tax relief. Like, it seems to me like you either give all your money to the government or you give it all to your pension. And the really rich, clever people give it all to their pension. I want in on this. What do I need to do?
Yeah, look, I think, again, as you touched on there, it's very rare that the government give you something for nothing. And to give it across 3 kind of strands is a real benefit. And I think it shows a commitment, to be fair, from, kind of government on government, or government after government, should I say, and that they recognise the importance of people having a pot of money to kind of pay themselves in retirement. But really the 3 main types of tax relief are, the first one, I suppose, is on the contributions that you make into a pension. And if you take it that pensions are effectively longer term savings, nowhere else for every €100 you save, if you're a higher rate taxpayer, will the government give you 40 euros back, or 40 cents in the euro. So to put it in simple terms, for every €100 if you're a higher rate taxpayer, you will get 40% tax relief up to certain limits on that. So it makes it attractive to kind of pay into it.
And break that down for me.
There's evidence out there that someone entering the workforce today will have 14 jobs on average through their career. So, the world of work looks very different than it did for maybe your parents, where, went in, would have had maybe 1 or 2 jobs. Pension came with it, it was guaranteed, it was based off of your salary, you never had to worry about it, it just kicked in the day you got your clock and your golf membership. That does not exist anymore.
Hi, good afternoon, and you're all very welcome to our webinar today on pensions for business owners. We have Ross McCarthy, Rafe Benson, Kristen Foran and Michael Houghton. So if I go to Ross, we'll come to you first. Business owners have thousands of things on their minds this year more than ever. So where do you see a pension fitting in with all of this?
So really where a pension fits into the scheme is ultimately it allows business owners to hedge their prospects. Too many business owners look upon, particularly those business owners that are building brand equity, or that means that their business has an intrinsic value that they may be able to sell on to somebody else at a high multiple, as opposed to selling time or having a franchise, where again it's more of a cash-driven model. The biggest risk, as we would see it, would tend to be in that latter part, where people think that their wealth is tied up in their business, and when they sell it, they'll extract the value. But that doesn't work in an era now where 25 years into the internet in Ireland, there are entire business models that are disappearing with each year that goes past. And one of the things that COVID has shown in particular this year is just how many business models that were linked to day-to-day staples of lifestyle have simply been, whether that's theatre, dramatic arts, performing arts, cinema. A lot of these businesses were 6, 7, 8 months ago were seen as fundamentally sound, long-term, cash-driven businesses, and they're incapable of withstanding the shock that they've been through. So one of the lessons that business owners should take out of this is that you never know when you're going to be automated away or simply become irrelevant. And if you're not providing for your future as part of the way that you run your business, it's like taking the blood out of your veins. You're not going to last long. And you're effectively not providing for a nest egg. And I suppose the last point I'd make is, just as that's true for the business owner, it's incredibly important with auto-enrollment on the horizon, that good quality options are being placed on the table that allow employees to manage their risk. And owners need to lead from the front. If you're not doing it for yourself, how can you expect other people to provide for their future?
And Kristen, what would your main message today be?
So my role is National Sales Director in Zurich Life, and what we are seeing are huge changes, I suppose, in pensions in the last few years. Some people are taking a bigger interest in pensions and many are not. As Ross said there, we're behind many other markets. And the key here is really, people understanding pensions better, because there's definitely an issue here with, I suppose, complications or perceived complications of pensions, that people don't understand them very well. And it's something we want to get across well, so this gives us a great opportunity to do that. Pensions remain the most tax efficient way, the tax efficient way of saving in Ireland as it stands at the moment. And there's huge opportunity here for wealth extraction for business owners. So really that's my key today, is really to talk about that and how you can actually take wealth extraction from a business in a hugely tax efficient way.
Thank you.
I'd love to start a pension, and I know I should, but I just can't afford it right now. Is there any point if I only have a small amount to put into a pension?
But there's limits on it, and I know there's a lifetime cap on what you can put in, and this is something ISME are looking at. Ross, do you want to talk to us about that?
Yeah, well, I suppose there's a couple of quick here. The first is there's a fundamental mismatch in terms of the treatment of income as income, whether you earn your income in the public sector or the private sector. So the actual way in which the value of the end salary that's taken within the public sector, it's done of 20 times your average last 3 years of salary, whereas there's a cap in place for private sector workers, and there's a substantial of public sector workers who would end up with a pension pot well in excess of 2 million in value, and there's nothing to them. And this includes at the very top of the civil service, who are on very substantial salaries, and they're currently or these thresholds. So ISME is currently supporting the pulling together of a challenge which is going to go in and test the constitutionality of that. So we're looking at a couple of different avenues to do that, but our fundamental hope would be that we'll be able to, worst case, move the threshold back to where it was before the last financial crisis, which was at about 3 million. And I think that will provide more help for a lot of people that are looking to manage their pension schemes and provide for the future. But this is fundamentally a question around equity and the equal treatment between people, regardless as to where they earn their money.
And then, Kristen, you obviously, through your role in Zurich, would handle pensions for lots of Irish businesses. So can you walk us through then in practice how that wealth extraction through a pension actually works?
Yeah, well, I mean, just as I said earlier on, I think it's about trying to keep it as simple so as not to complicate it too much for people. The way I see it is, you've set up a business, hopefully you are profitable, you're doing well, and just as Ross said there, many people tend to leave money there and that build up the value of the business. And I think it's a bit of an outdated notion. The way I see it is you have three options when it comes to the profits that you're making in your business. One is to indeed leave it there. You pay corporate tax at 12.5% whenever you extract it. You could be paying a surcharge of 20% if you have a closed company, and you could also be paying capital gains tax of 33% on the sale of your shares. The second option I see is to withdraw money from your business, so take it out as a salary. You pay high income tax, you pay USC, you pay PRSI. In effect, you could pay up to 52% of it. out as a tax return. Your third option then is to actually put money from your profits straight into a company pension, so as an employer contribution into a pension. The employer gets tax relief of corporate tax rate of 12.5%, and the employee doesn't pay any income tax, not any income tax or PRSI or USC charge on it whatsoever. That money is going into a fund. That fund will build up tax-free. You'll probably add to that fund again in the future. And what you'll end up then is a very, I suppose, a tax-efficient vehicle that will build up a huge fund for you potentially for when you actually retire. So you're extracting your money from your business in a very tax-efficient way. And you also can do it at quite large limits. You know, when you look at putting money into an executive pension or an employer-based pension, we can do a funding quote which tells us how much money you can actually put in, and those limits can be quite high. So what you could find is you could be building up a pot of maybe €2 million, taking that money efficiently from your business and not paying tax on that money, which otherwise you would have paid quite a lot of tax on. You still come out at the end of the day with still, I suppose, an efficient business there, but you also have this pension fund, a fund that can't be touched if anything goes wrong with your business in the meantime. So it is providing you for your future. And again, it goes back to this idea of, you know, your financial independence, retiring early. If you're making those plans, this will give you the means to actually follow those through. So it's a hugely tax efficient way of actually getting to a point of your business working for you officially.
Thanks, Christian. Michael, you mentioned earlier that you hope to be financially independent in a number of years. So you obviously run a small business and you've been doing this aggressive funding. So can you talk us through that experience when you started and you know, how's it all gone? What lessons have you learned that you can share?
Yeah, to be honest, I've learned so many lessons I probably couldn't cover it in the webinar we have now, but look, to summarize it briefly, I basically got my business to a point where it started making extra money. And I then had the option, similar to what Ross was mentioning earlier, that I had the option to either take it as salary or to keep it in the company or to actually move it to a pension. And when I looked at all of the options, it was a clear no-brainer that the pension movement was the best one to take. And very much now I've put the business in such a state that I always pay those pensions first. I'm more keen to make those contributions than I am my own salary in many cases, in terms of just having that kind of mission. And I think the automation is fantastic as well, in terms of, you know, you can automate the process into your pension so that you don't even see it as, or you don't even have to physically make the payment. It just becomes what feels like a normal expense every month. So yeah, it's a huge part of our family's long-term wealth plan. As I mentioned, our business is solely tied to time. So, you know, it was very much that feeling every year of, right, I need to get up and go again and keep working. And look, what happens if I can't work for whatever reason, or, you know, I'm in the IT industry, so technology changes so quickly. What happens if the technology that I'm using suddenly becomes outdated and I can no longer find projects for that technology? So it's very much about putting long-term plans together. My own background, being from New Zealand, we don't have anything near a 50% top tax rate. We're more around the top 30% top tax rate. So when it came to looking at that and trying to work out a way to actually plan tax efficiently, then it was really a no-brainer in terms of utilizing.
Hello and welcome to this live masterclass, Property and Your Pension for Pensions Awareness Week 2020. A pension is one of the most attractive ways to build wealth through property. And here to talk to us about the mechanics of that are Fergal McKenna, David Jelly from Property Bridges, Susie Nolan from Aviva, and David O'Mara from Greenman Investments. So to get started...
And I guess what we're really trying to do is get the ear of the customers out there and get the voice of the customers and have a bit more harmony with regards to the products that are available to people out there. And we can stop talking about a pension bomb, perhaps, and talk about the pension opportunity that exists. There's plenty of anecdotal stories that I have about people who haven't realised as they're investing in property outside of their pension that there were options inside their pension, and they realised quite late on that actually, had they understood the options earlier on, that there were those options to create wealth within their pension.
And so David is of course joining us today on the panel. So David, you're very welcome.
Hi everyone, so I'll just introduce myself. So my name is David Jelly. I'm the founder and CEO of Property Bridges. So Property Bridges is an online platform that allows people to invest in property through an online medium. So we really set up to allow Irish people to invest in Irish property through the ease of a platform. So first and foremost, we're a peer-to-peer platform. So we've got 3,000 investors that have lined up with us and are investing. And we were really driven to pensions from a client need. So as Fergal said, we joined Fergal on the Pensions Roadshow last week. And there was a real thirst from our investors to give them an option to invest through their pension. So as most of us will know that pensions, investing through your pension is one of the most efficient ways to invest from a tax perspective. So we allow people to invest in Irish property through a self-administered pension through the investment offerings we have on our platform.
Some of my friends have invested in shares through their pension and others have invested in property. Both of them are telling me it's the way forward and I'm really confused. Should I invest in shares or should I invest in property? Or should I invest in my pension, and if I do that, what am I being invested in?
The expert. So, Susie, I might start with you for that question.
Sure, thanks Carol. Again, great question. It is the kind of thing, as you said, sitting on a bar stool, people have all sorts of advice. Sounds like he should take a little bit of advice from both of his friends, in my view. So you'll hear me mention time and time again diversification. I've mentioned it in relation to property, so diversify across property sectors, but also diversify across asset classes. And obviously that's something that Aviva brings. You can go into your pension through Aviva and invest in lots of different asset classes. But looking at equities and property, as the gentleman has asked, I suppose they're quite different. They're very different, in fact. Equities, it can be quite volatile, literally up and down over the course of a day, never mind day on day. Property can tend to give you a slightly smoother return. I think what I would emphasize as well, as I mentioned earlier, is that property is a long-term investment. So just to bear that in mind, I think, and if you look at, I think we might have a bar chart that we should be able to share. If you look at the property returns over the medium and long term, they have actually surpassed the returns of bonds and equities over the 3, 5 and 10 year time horizon. So again, when you're thinking about your pension, and certainly that gentleman's got a fair few years to go until retirement, lucky him, so he'll be thinking long term. So he can see there on that graph, hopefully, that it is a long-term investment. Equities absolutely have their place. I think it's important to understand where you are. There's a concept called lifestyling, so know where you're at now. If you're younger, you might have more appetite or more ability to take on a bit more risk, which, you know, the volatility of equities kind of brings with it. And then as you get closer to retirement, you might want something a little bit safer. And, you know, the likes of Moneycube can obviously help you on that journey as you approach retirement. One thing I just mentioned, just while we're on equities and property, and it came up in your poll question actually there, Carol, is the concept of REITs, or real estate investment trusts. Just to emphasize, if people think that by investing in a REIT they're getting property exposure, I think we might have another line graph that we can show here. Just to emphasize that REITs are very closely correlated with equities. They aren't necessarily correlated with what's going on in the local property economy. So just have a look there. If you can see the two very jagged lines, that's, say, for example, Hibernia REIT, which would be quite well known here in Ireland, and it's a great REIT, absolutely. But you can see how closely correlated it is there with the Euronext Dublin Index. So very closely correlated with equities, even though it is a property investment trust. Whereas the kind of orangey red line you can see up the top there, that's the Aviva Irish Commercial Property Fund. So a much smoother return, much less volatility. So just to bear in mind, you know, in terms of equities, obviously there's lots of equities out there. If you're looking at a property equity, it is correlated with equities, not with the property market. So just to emphasize that point. But I think that gentleman should take a little bit of advice from both of his mates, put it together and have a diversified portfolio, but make sure to get a bit of advice to make sure you're getting the right balance in there.
And David O'Mara and Greenman, we might just come to you on that in terms of developing an appropriate mix.
Yeah, I suppose we would be back again to property being too big a catch-all. We would be at a totally different end of the market. We take a very long-term buy and hold strategy, what we have. So we don't get involved in development risk or development speculation. So we would take properties that are let to kind of the leading tenants in Germany and let them very long-term leases. So as an investment manager, we're just really interested in the lease and how sustainable who the lease is with. If that's with one of the main food retailers in Germany, how long that lease is for, and the underwriting or the due diligence we do is how sustainable is that location
for the long term for food retail. So we put a lot of time and effort into making sure that not just for the next 5 or 10 years, but 15, 20, 25 years, will this property that we're buying be able to generate a kind of 5.5% net return to our investors over that period of time. So what we can provide to an Irish investor through their pension structure, either on the pre or post retirement side, is the opportunity to get access to the income from these retailers. So the main retailers we deal with in Germany are Edeka, Rewe, Kaufland, and the Schwarz Group that owns Kaufland and Lidl and Aldi. So between them, they sell about 85% of the food in Germany. None of them are publicly listed or publicly traded companies. So, and they're 4 of the top 5 retailers in the European Union. So one of the only ways to participate from an investment perspective in these kind of really large and dominant retailers is to do what we do and own property and get a return from that rental income. So we really provide that income option for an Irish investor, and also crucially a geographic diversification and an investment outside of the Irish market. And I think it sits in alongside and could complement something totally different from the property perspective, like what Susie runs in the Aviva fund, and something much more kind of short term and value add or opportunistic like David in the property purchase.
So good afternoon everybody, and welcome to the Women in Pensions session of Pensions Awareness Week. Thanks a million for taking the time to join us this afternoon. We're set up for a really interesting discussion. We have a panel of experts who I'll introduce to you before we start. We have Terry Kelly-Orris, who is Head of Public Policy at Irish Life Group. Welcome, Terry. We have Leanne Long. Leanne is founder of financiallyfit.ie, which is an online platform created to inspire young women to take control of their financial lives. Welcome, Leanne.
Hi, Susan.
And we have Olive Ryan, who is Head of Client Services at Moneycube. Hi, Olive.
Hi, Susan.
In Ireland, women's pensions are likely to be 22% less than men's. Women join pension plans around the same time as men. They contribute similar percentages. They follow similar investment strategies, yet the difference in final tally is significant.
Okay.
Irish Life.
What are the facts here? What is the 22%? Where did that come from? What is the gender pay gap that we have in pensions at the moment?
Hi, yeah, well, as you can see from our video, we did a bit of research in Irish Life. So we looked at 80,000 pension members across nearly 1,400 pension schemes, and we did a comparison between men and women to see what was happening in pensions real time now, and that's from the very big employers to smaller employers. And I suppose 3 factors kind of stood out. One was one of the big factors of the differential between the pension sizes, and that 22% came from our own research, was the salary differential. So on average in Ireland, there's a 14% salary differential between the genders, and that gets compounded from when you look at the pensions. And why is it coming out so high through the pensions? Well, one's the salary. The second one is time taken out of work, and in particular when women take time out of work for caring responsibilities, for maternity leave, and when you take that time out of work, it can have a real impact on your pension scheme. So if you take a couple of years out of work, which is unpaid, in your 30s, and you roll that forward, the impact that has on your pension can be quite big. And then the third factor, which is again crucial and very specific to women, is that women tend to live longer, which is great, but what you end up then with is a smaller pension pot for having to live on average probably about 5 years longer than a man will have to live. And when we dug down into the statistics within our own schemes, we found that the differences weren't being caused by women starting their pensions at a different age, because men and women were starting more or less at the same age. It wasn't due to the fact that men were engaging in kind of more risky, more active investment policies, which was giving them a greater yield, because actually they were coming out at around the same. And it was basically down to the factors that are the salary differentials and the times out of work.
And if I was to get in touch, say somebody in Irish Life or Moneycube, to have a chat with a financial advisor, I suppose are people, is that going to cost me a fortune? Will I come out with a bill for having spoken to somebody and all that? Because I don't know if that gets in the way sometimes of picking up the phone, of going, how much does this advice cost me even to get this started? Is it expensive?
Really good point, Susan. No, it's not. It's actually free. Most financial advisors won't charge you anything for a consultation. So you can talk to anyone, any financial advisor, to get information about yourself. How financial advisors supposed to get paid is through the provider that you set your pension with. So they provide a commission payment to the provider or to the financial advisor for that. So it won't cost you anything. And try, I suppose, to find a provider who will also make sure that 100% of your money, is really key, that 100% of your money is invested, so that none of that is being lost through any commission payment to your financial advisor. There are options for everyone to do that for you, so don't make sure you check that with whoever you go to make sure that they're doing that for you. But it won't cost you anything. You can pick up the phone, send an email, look for people online. There's a great website called Brokers Ireland, which has a list of all the financial advisors who are on their membership from around the country. So there's plenty of people out there. If you Google that, you'll find somebody and get in touch with them. They won't do it. It's completely free. You won't cost you anything.
Okay,